Yeah, good afternoon, guys. I actually want to say welcome to, welcome to Analysis King. Um, I actually want to say thank you for the subscribers, for subscribing to my channel, and also even giving out time to people watching video. I actually want to say I appreciate you guys. I want to thank you. Uh, I want to thank you very much. Right. So, um, it actually shows to me that actually you guys like the video, right? So it actually shows to me that you guys like the video. But if you want to see more of those videos, more of the analysis videos, more of the teaching videos, right? All you have to do is to click on that subscription button, subscribe to the channel, like the videos, right? Turn on the notification buttons to to know when I upload more videos, right? To know when I upload more videos, right? So let's get into today's class, right? So we actually want to talk about liquidity. Now, this is basically the main thing that everybody talks about: liquidity, blah 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 in market, right? So everybody talks about liquidity. Everybody talks about what is liquidity, liquidity. But the thing is that a lot of people don't really give a simple explanation of what liquidity is, right? So basically, we don't need to. I don't need to go too much deep, right? So I can actually tell you what liquidity is. Liquidity is just the highs and the lows in the market, right? So you don't need to. You don't need to we don't need to go deep into the liquidity issue, right? So liquidity are where money resides, where buyers bank, where buyers place their stops, and where sellers place their stops. Right? You can actually see it in the market. So we can actually see liquidity here. We can see liquidity here. We can see liquidity here. All these regions are actually liquidity, right? So we all these regions are where buyers place their stop orders, right? So we can actually you can notice that there are stop losses here, there are stop losses here, there are stop losses here. All these are all liquidity points, right? So all these are all liquidity points. But the first thing you actually want to understand when it comes to liquidity is the first thing rather you want to understand is, like I always say, you need to understand structure. You need to understand the structure of the market. If you don't understand the structure of the market, you would get lost in the market, right? So the first thing these guys they do is what the banks they do is they will go to they'll open a chart, right? They'll open a chart. Now they will, from their algorithm, right? Or from their algorithm that they've actually built, they will look for where is the most liquidity, right? Where is the most liquidity in the market? Now, what do you think they did, right? If it, let's use euro NZD to actually analyze the chart. Now you can actually see that price actually created a double bottom. Now, a double bottom also is a trap region, right? So whenever you see a double bottom, any single place is actually a trap region. Now, what do you think they did? They went up, right? They created a double bottom around this region, which is actually what also a liquidity point, right? So most traders actually use chart patterns. But the truth is, let me be very plain to you, chart patterns don't work. They actually don't work, right? So what actually works is liquidity in the market. What actually works is trading smart money concept. These are the things that actually works, right? So there are liquidity around this region. Why? Because we can see double tops, right? We can see these double tops, but sellers actually placed their stop loss in the market. The bankers they open the charts. Let's say they open the Euro NZD and they actually look at this particular region. That this region right here looks very interesting because when they place their orders, they actually see the figures, right? You just see the charts, but they actually see the figures. They see the actual figures in the market. Now they come back down here. I'm going to show you something again. They come back down here to take out the same liquidity point that the people talk about. So this is a double top. The this is a double bottom and this is a double top. This particular region is a liquidity point. This is a liquidity point, right? So they actually come back to this region. They came back to this region, stopped them out, then they reversed heavily. Anytime you actually see a double bottom, anytime you see a double bottom on or a double top, you actually know that that particular region, this is where the most liquidity resides, right? Anytime you see a double top or a double bottom, it shows that this is where the most liquidity in the market resides around a double top or a double bottom. They actually create it every single place in the market, both on the higher time frame, both on the smaller time frame, right? So these guys, they create these regions intentionally, right? They create these regions intentionally so that they want, once they want to go back into that region, they already have orders around this region, right? They already have orders around this region. So they will go back into this region. They will take the stop loss around this region, trigger their orders, then they move back to the downside. You can see how sharply price actually moved right around when they've actually taken out this double top, right? The same thing, you can see how price moved sharply when price create and moved away from this double bottom. So when you see a double bottom or a double top, it actually shows that there are most liquidity in that particular region. There's that I call it a trap region, right? I call it a trap region because anytime they go back to that region, they will go back to that region, look for a supply or a demand zone around that region. They will hit that supply or a demand zone, then they will go back down, right? Anytime you see a double top or a double bottom, this is what basically what happens. Now, let me use this as an example, right? Let me stop share this. Let me use this. This is this is basically what happens when you see a double top or a double bottom, right? Let's say let's say the market has been going sorry, let's say the market has been going bullish, right? Let's say the market has been going bullish. Sorry. Let's say the market has been going bullish, creating higher highs and higher lows, right? So now what these guys they do is they will come back to this region, right? Come back to this region. Price has been ranging. Now price created a double bottom, right? Price created a double bottom. What these guys will do is, sorry, uh, sorry. Pardon me. Uh, Right. So what these guys will do is that they will come back to this region. Now, this region, they will come back to this region, right? Take out the stops around this region, right? They will take out the stop around this region because they've seen that we'll have equal lows, which is actually a liquidity point, right? They see that we'll have equal lows in the market. So they will come back, take out the stop losses around here, intentionally create a demand, right? Because they know that around these people, they know that people trade chart patterns. So once people see these equal lows, they say, okay, fine. We see double top and double bottoms, right? But what these people they actually do is they will intentionally create these equal lows, take out the equal lows around this region. Once they take out the equal lows, they would come back. They've actually created a demand already waiting to be tapped. They already have their orders around this demand zone. So once they take out this equal lows, they will come back, tap into this demand, then they will move back to the upside. Then they'll move back to the upside. So these are the kind of patterns you actually need to see, right? You want to see double bottoms. Once they see double bottoms, always look for a demand or a supply, double bottoms or double tops, right? Always look for a demand or a supply zone below or above the double tops and or a double bottoms, right? And also remember structure. Structure is very key, right? So you can't do anything without structure, right? So this is exactly what they actually did. Now let's go back to the chart. Let's see. Let's go back to the chart. We go back to the chart. Um, Now look at what these guys did, right? So look at what they did. Now, if you go back into, let's go to the 4 hour, or let's go to the 4 hour, right? Or the 2 hour. Um, right, right, perfect. Um, so let's go to let's go to the 8 hours, right? Let's go to the 8 hours. Let's see what happened around these double tops and these double bottoms, right? So let's go to the 8 hours chart. Now, if you go to the 8 hours chart, you will definitely see exactly what I was actually explaining to you. Now, you can see that they have a demand zone around this region, right? This is an 8 hours chart, right? So you can actually see that they have a demand zone around this region. What they did is that, like I explained, what they did is that they intentionally created this particular double tops and double bottoms. They intentionally created these double tops and this double bottom. Then they raid these double bottoms. They came back, they created a demand, like I said, that they will create a demand below or above the double tops or the double bottoms, right? So they intentionally created this demand zone, then rallied back up to the upside. You can see how swift they rally back up to the upside. So they do this thing every single day, every single time. The first thing you want to understand is structure, right? Like I said, you want to understand structure and the liquidity point. There is nothing about liquidity. Everything about liquidity is just the highs and the lows in the market. We have liquidity here, we have liquidity here, we have liquidity here. All these are all stop losses, what we call protective stop, right? So all these are all protective stop. So if these guys are actually going back up to the upside, where will be your target? Your target will be here, right? Your target will be here, this region. That will be your first target. If they take out if they take out this particular region, if they take out this particular region, so if they take out this particular region, if you take out this particular region, meaning that they've broken structure. Now, once they break structure, right? Once they break structure to the upside. Now, what they will do is they will come back into a demand zone that they've created, like I explained, into a demand zone that they've created. Then now the next question you need to ask yourself is, since they've broken structure, we've seen that the market has changed. Where is the next liquidity point that I need to check, right? So this is the next liquidity point. Next liquidity point is the next high. The next high is the next liquidity point, right? The next high that they actually created, right? So this is the next liquidity point. Now you can see that structure has been broken around this point, right? Now structure has been broken. They will come back into a demand region, right? They will come back into a demand that has been created. They will create a demand, then they will head back up to the next structure. So it is, to the next liquidity, right? So it is from one liquidity to the next liquidity, one liquidity to the next liquidity, right? So basically, liquidity is all about highs and lows in the market, right? So let's see other chart. Now let's see the USD share. Let's see the USD share. USD share, one of my favorite pairs. So I'm actually in this trade. I actually called this trade, right? So I called this trade for the members, for my members, right? So I called this trade for my members, and most of them are actually in this trade, right? So you can actually see the price is going like I actually explained. Now you can see basically every single thing that I'm explaining to you. This is exactly what is happening, right? They've come back, they've taken out liquidity here, they've taken out liquidity here, they've taken out liquidity, broke structure, right? They've broken structure, taken out liquidity, right? Now, what did they do? They come back into this particular demand zone, right? They come back into this particular demand zone, filled the demand zone, then broke the structure again. Now they've broken structure, meaning that, and this structure they broke, you see that there are some people that were selling here, right? Some people were selling here, and we have stop losses around this region. What they did is that they tapped out the stop losses, they broke structure, they came back, created another liquidity, created another demand zone, right? Taken out liquidity, broken structure, came back into the demand zone, created, right? And they are moving back up again to take out the recent structure that was broken, which is actually a liquidity point, right? So we've come actually to the end of the video, right? So the first thing you want to actually understand is, where is the direction in the market? That's the first thing. First thing you want to know is the direction of the market. The second thing you want to know is where is the liquidity? Where are they residing? Where is the highest form of liquidity, right? Once you've identified where the highest form of liquidity is, then you look for structure, right? You start looking for structure on the lower time frame to go back up to all those liquidity points, right? Don't forget to subscribe. If you enjoyed this video, don't forget to subscribe. Don't forget to click on the notification buttons to know when other videos will be out, and I'll see you in the next video.